welcome to the Money Show Orlando, and we are with a terrific educator in the market. I've known him for decades, and he started Pristine Trading, and he is the founder of Pristine Trading, but he also does a lot of great research for investors. And I've asked him to come here. He hasn't been back in how many years now?
Oh, 5, 6, 7 maybe?
Yeah, so we're happy to have him back for the first time. So Greg, what are you seeing with the new administration? His expertise is market timing and obviously also stock selection, and we'll get to that in a minute, but what are you seeing for the market?
Well, it's interesting, but before we go there, I want to say, while I created Pristine Trading and that method, I'm now master trader.
Okay.
Right, so yes. I've given that up and moved into now doing it as mastertrader.com, but everybody's interested in the market. Has it gone too far? It's been going up now almost 7 years, so it has to come down.
Right.
That's what everybody believes. And sooner or later it will, of course. But I subscribe to following the trend in the most basic level, meaning what is an uptrend but higher highs and higher lows? So if I'm following that from a long-term perspective, monthly, weekly charts, the trend is going up. So while I do some short-term market timing for entry points, that long-term trend is up until it isn't. So whatever the opinions are of those on the street, and some of them sound so compelling.
Yes, they do.
Based on fundamentals, earnings, and so on. It continues to go up. So why should I argue with that?
So you follow the trend. And when do you identify, normally do you see a sideways action? And so you'll identify the sideways action, you'll warn your subscribers.
Right, well, once it starts going sideways, one of the things that I look at is how do traders and investors feel about the market? One of the ways of looking at that is through options strategies. Are they buying too many puts or too many calls, and looking at that on different time frames? So markets typically come to an end, as you know.
Right. We've been at this one a long time.
Correct, but until most believe it.
Right.
So it's so obvious, and they believe it to the point where I have to jump in. So they do that through where the leverages, options. So that's one measure, as well as the trend begins to accelerate when more and more believe in it. So when we see a combination of factors, that's what we first know it's time to get a little concerned.
And you haven't seen that yet?
No. The market goes sideways.
Is it shocking to you?
Well, it is. It is, because from a historical perspective, it's like, okay, 3 years, 4 years, 5 years, 6, 7.
Consumer confidence is at an all-time high.
That's part of it. That's one step. Now, the other thing is interest rates. So the big worry is, well, the Federal Reserve has now started to raise interest rates. So that's going to end it. Well, no, historically it does not. It doesn't happen until the yield curve inverts. And that's the major thing to look for, because as I've done my research over the years, it's like, well, what moves the markets? What creates a bear market? And one of the things that I read, not something I created or discovered through my reading, was there's only 2 factors that have created recessions and that followed bear markets. And the Federal Reserve did 2 studies, one in 1996, one in 1999. And they looked at so many different internal indicators, economic indicators. An inverted yield curve was the only thing that showed that it had predictability.
Interesting.
So until that happens, it happened in 1999 or 2000, and we know what happened then, right? About a 95% decline in the NASDAQ. And then it happened again, I believe, in 2007 or 8. Market went down. It's still bullish.
It's still bullish. Well, there you have it. We are still bullish on the market, according to Greg Capra and many of the speakers here at Money Show. So tune in, and thank you, Greg, for all you do for individual investors.
Thank you.
Thank you.